Ever wonder how banks make money? It's a question that might have crossed your mind while walking past a bank or using an ATM. It's not just from those pesky ATM fees that seem to pop up at the most inconvenient times. The truth is far more intriguing and complex than you might think. Banks have a superpower, a trick up their sleeve that allows them to operate in ways that seem almost magical. They can literally create money out of thin air, a process that is both fascinating and essential to our economy. It sounds like something out of a fantasy novel, but it's the reality of our modern financial system. This ability to create money is what keeps the wheels of commerce turning. Buckle up, because we're about to demystify this seemingly magical process. Think about it for a moment. When you deposit money into your bank account, it doesn't just sit there in a vault gathering dust. Banks don't hoard your cash like a dragon guarding its treasure. Instead, they put it to work. They use your deposits to create even more money through loans and investments, a process known as fractional reserve banking. This newly created money fuels our economy, allowing businesses to grow, families to buy homes, individuals to purchase cars, and yes, even to enjoy those avocado toasts everyone's obsessed with. But this money-creating power isn't without its risks. The system can be fragile and is susceptible to economic downturns and financial crises. Understanding how it works is crucial for anyone who uses money, which is pretty much everyone. Financial literacy can empower you to make better decisions and navigate the complexities of the banking system. By educating ourselves about these processes, we can better understand the role banks play in our lives and the broader economy. So next time you walk into a bank or use an ATM, remember the magic happening behind the scenes. It's not just about storing money, it's about creating opportunities and driving economic growth. The magic of banking is all around us, shaping our world in ways we often take for granted. And now, you know a bit more about how it all works. Let's get one thing straight. Money isn't just those crisp bills you carry in your wallet or the coins jingling in your pocket. Those are just physical representations of money. In reality, money is a much broader concept. It's anything that's widely accepted as a form of payment for goods and services. Over the centuries, money has evolved from simple bartering to sophisticated digital transactions. Think back to the days before money existed. People traded goods and services directly through bartering. Need a new axe? Trade some of your surplus grain with the local blacksmith. This system worked, but it had its limitations. What if the blacksmith didn't need your grain? What if you couldn't agree on a fair exchange rate? Money solved these problems by acting as a common medium of exchange. As societies grew more complex, the dynamics of trade and commerce began to evolve significantly. In the early days, bartering was the primary method of exchange. People would trade goods and services directly, but this system had its limitations. As communities expanded and trade networks grew, the need for a more efficient and versatile form of money became apparent. Coins made of precious metals like gold and silver were introduced, but even these had their drawbacks, such as being heavy and difficult to transport in large quantities. Enter the concept of IOUs, the ancestors of modern paper money. These simple pieces of parchment represented a promise to pay a specific amount of goods or services in the future. They were revolutionary in their simplicity and effectiveness. Imagine a farmer needing a new plow but lacking enough grain to barter. In a barter system, this farmer would be stuck, unable to acquire the necessary tool until after the next harvest. However, with the advent of IOUs, the farmer could approach a wealthy landowner and ask for a loan, promising to repay the debt with future harvests. This arrangement allowed the farmer to get the plow immediately, increasing productivity and ensuring a better yield. This promise, written down as an IOU, became a form of money. It was a tangible representation of trust and future value, allowing for more fluid and flexible economic interactions. These IOUs could then be traded within the community. They were not just promises between two individuals, but could be passed on to others, creating a network of trust and credit. For instance, the landowner could use the farmer's IOU to pay for services from the blacksmith. The blacksmith, in turn, could accept the IOU knowing that it held value and could be used for future transactions. The blacksmith could then use the IOU to buy goods from another merchant who might use it to pay for raw materials or other necessities. This created a chain of transactions, all based on the initial promise made by the farmer. This system was based on trust and reputation. Each party involved had to believe in the credibility of the IOU and the integrity of the person who issued it. Trust was the cornerstone of this early financial system. Everyone involved had to believe that the IOUs would eventually be honored. This mutual trust fostered a sense of community and cooperation, essential for the smooth functioning of the economy. This marked a crucial step in the evolution of money, moving away from physical commodities to a system based on credit and promises. The introduction of IOUs laid the groundwork for modern financial systems, demonstrating the power of trust and the potential of abstract representations of value. The Goldsmith's secret: early fractional reserve banking. The story of how banks create money starts with goldsmiths. In a time when gold and silver were the primary forms of money, people deposited their precious metals with goldsmiths for safekeeping. The goldsmiths issued receipts for these deposits, which could be exchanged back for the gold or silver on demand. These receipts were essentially early forms of paper money. Here's where things get interesting. The goldsmiths realized that not everyone came to withdraw their gold at the same time. They saw an opportunity. They started lending out a portion of the deposited gold, keeping just enough on hand to meet the usual withdrawal demands. They issued more receipts not backed by actual gold but by the promise of repayment from the borrowers. This was the birth of fractional reserve banking, the system that underpins modern banking. Modern money creation, the multiplier effect in action. In this section, we will delve into the fascinating world of modern banking and how the multiplier effect plays a crucial role in money creation. Fast forward to today, and the principle remains the same, just on a much larger scale. The financial landscape has evolved, but the core concept of the multiplier effect continues to drive the economy. When you deposit money in a bank, it doesn't just sit there. Your deposit becomes part of a larger system that fuels economic activity and growth. The bank is required to hold a fraction of your deposit as reserves, known as the reserve requirement. This ensures that the bank has enough funds to meet withdrawal demands. The rest, they lend it out to other customers. This lending process is what keeps the wheels of the economy turning, providing funds for businesses and individuals to invest and spend. Here's where the magic happens. The money you deposited starts to multiply through the banking system, creating more money in the process. Let's say you deposit $100, and the reserve requirement is 10%. This means the bank must keep $10 in reserve. The bank keeps $10 in reserve and lends out $90 to someone else. This $90 is now available for someone else to use, invest, or spend. That borrower then deposits the $90 into their account, and the bank lends out another $81, keeping 10% in reserve. This process continues, with each new deposit allowing the bank to lend out more money. This cycle repeats, with each loan creating new deposits and further loans. The initial deposit of $100 can eventually lead to a much larger amount of money circulating in the economy. This is called the money multiplier effect, and it's how banks create money out of thin air. By lending out a portion of deposits, banks can significantly increase the money supply, which in turn stimulates economic activity and growth. Understanding this process is key to grasping how modern economies function and thrive. If you found this explanation insightful, please subscribe to our channel and like this video to support our growth and stay updated with more content on financial systems and economic concepts. Your engagement helps us continue providing valuable information.